Good afternoon. It's 2 p.m. It's a Tuesday. This is Market View. Thank you for joining us. My name is Lungelele Makakula. You can watch us on our YouTube page. It's Eswatini TV. China's economy grew more strongly than expected in the second quarter as it proved resilient in the face of Donald Trump's trade war. China's gross domestic product grew 5.2% in April to June compared with a year earlier, slowing from 5.4% in the first quarter, but just ahead of analysts' expectations for a rise of 5.1%. The world's second largest economy has so far avoided a sharp slowdown, in part due to support by Beijing and as factories took advantage of a U.S.-China trade truce to make shipments before tariffs kicked in. However, investors are bracing for a weaker second half as exports lose momentum, prices continue to fall, and consumer confidence remains very low. Sanil Spia, in-house economist, will join us via Zoom for his insight on this. And in our business news today, Eswatini is hosting the Interstate Oil Committee meeting, bringing together energy officials and stakeholders from SADC countries. Let's go straight to our first story. Eswatini is hosting the Interstate Oil Committee meeting, bringing together energy officials and stakeholders from South Africa, Namibia, Lesotho and Botswana to discuss strategic cooperation in the petroleum sector. The convention of these 5 countries comes at a time when the region is seeking to strengthen energy security, stabilize fuel supply chains, and explore infrastructure development to support economic growth.
Eswatini currently imports refined petroleum products, mainly through South Africa, which makes the country vulnerable to oil price shocks and logistical disruptions. The Minister of Natural Resources and Energy, Honorable Prinsloo Nkokela, says the meeting is a critical step towards regional coordination on oil importation, storage and distribution.
Globally, the petroleum sector faces complex challenges, which include fuel price volatility as a result of market fluctuations, political instability, environmental concerns, and security of supply risks. It is therefore critical for countries to re-examine strategies in order to ensure sustainable approaches to address these challenges. Despite national efforts to increase the uptake of LPG in Eswatini, there are still challenges such as supply bottlenecks, high cost, underdeveloped distribution networks that hinder the uptake of LPG. I'm optimistic, though, that this dialogue will help us share experiences and best practices to improve successes to LPG.
The acting CEO of the Eswatini National Petroleum Company, Musa Shongwe, says Eswatini's fuel supply systems are not yet secure, which poses a threat to trade within the SACU region.
Eswatini as a country does not currently keep strategic fuel stocks, simply because currently we do not have a strategic fuel reserve facility. Fuel supply security for the region requires that each country should make sure that they do keep strategic stocks to ensure that there is no disruption in the availability of fuel in that country and ultimately in the region.
Business Eswatini CEO Inathi Dlamini says though fuel insufficiencies in the region affect businesses, they appreciate projects that will help boost operators in this industry.
Private-public partnership against the backdrop of the strategic fuel reserve, which is timely. You will remember this. We've had problems in this country of fuel shortages in the past because most of all the fuel companies in Matapa can only keep fuel maybe for only a few weeks. If you close the border, which means the fuel is finished within a few weeks, and the strategic oil reserve seeks to store fuel for months, which guarantees supply. I think that's one good thing about that project. We are yet to learn how the various companies will participate in that strategic asset that we are building over there.
Currently, Eswatini has a strategic oil reserve under development with 5.2 billion emalangeni to mitigate vulnerabilities to fuel supply and global shocks. For Market View, Notiles Tole, Vomingo Sinzinisa and Derek Msibi, Ezulwini.
S&P Global has projected that end consumers and the African continent will not be majorly impacted by global demand slowing down on oil supply. S&G's Associate Director of Crude Oil and Refining was speaking at the Interstate Oil Committee Conference in Ezulwini that explores options such as joint bulk procurement, refinery and strategic oil reserve, and cross-border pipeline development to improve cost efficiency amongst SACU member states. He says as a landlocked country that relies entirely on imported fuel, Eswatini stands to benefit from a well-coordinated regional energy strategy.
We anticipate a market that is going to be continuously oversupplied, especially with crude oil, as a result of OPEC Plus decisions to ramp up production quite rapidly, even at a faster pace than they had initially indicated. Now, of course, there will be a time that perhaps they adjust this pace, or they might even, either later this year or early in 2026, they go ahead and actually do further cuts. But in the current market, we certainly do expect that going after a bit of a market share in terms of pushing non-OPEC plus production slightly lower compared to where it has been over the last several years, to a lower volume. But that would certainly translate to, lower prices would help and consumers, right, in terms of refining demand, refining product demand, and especially, gasoline prices, gas oil prices, fuel oil. But that doesn't mean necessarily that we're going to see a huge increase in demand because low prices are lower. I think we will see these cycles of oversupply and undersupply and supply management, and that would, although you would argue that it should help the end consumers in terms of price, volatility side of it doesn't really help because it kind of deters investment for the longer kind of time frame. Overall, we do expect, especially products to come under some pressure towards the end of the year, and that's a lot due to the fact that you see kind of demand starting to decline towards the end of Q3. As a result of northern hemisphere's summer season demand kind of fading away, so we should see some pressure on prices. But in terms of end consumers, especially when we talk about Southern Africa region and Eswatini, where we are today, I think it's going to be some time until we really see the impact of global demand growth slowing down continuously on the regions. I think supply will kind of continue to be one of the driving factors, and as a result, we will still continue, unfortunately, to see some fluctuations.
Right, and that's it for our business news. 8 minutes after 2. After the break, we're joined by Senator Bia, who's our in-house economist. We discuss China's GDP growth from April to June this year.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.za.
Get ready, Eswatini. The Battle of Brains is back on your screens. The Mbabane Municipality Council Spelling Bee is back live on Eswatini television.
Please spell the word fairness. Fairness. Fairness.
Witness the spelling mastery, creativity, and determination of our youth as they compete for the top prize.
Please spell the word rebellious.
Rebellious. REBELLIOUS.
Don't miss it every Tuesday at 5 p.m. starting this July on Eswatini TV.
Hi, I'm Golda. I work at the IMF. What is globalization? Well, think of it like a bridge between two countries. Now let's say this country is very good at growing flowers. It has the right soil and plenty of skilled farmers. And just across the river, that country loves flowers, but doesn't have the right soil to grow them. You can see where I'm going with this. With our bridge, trade has blossomed. This country makes money from selling flowers abroad, and that country can start new businesses and sell new products based on their newfound access to flowers. I mean, who doesn't love fresh flowers? Of course, it's not just flowers that can cross the bridge. It can be used to trade almost anything. Plus, there are pathways for investing, communicating, and exchanging ideas. And people can come and go too. Now, what does this have to do with globalization? Well, imagine bridges just like this, connecting countries all over the world, even countries on opposite sides of the planet. That's globalization. These bridges, these economic links, have made everything from food to electronics cheaper. And not just that, globalization has made the whole planet richer too, especially people in poorer countries. Over the past 30 years, 1.5 billion people have been lifted out of poverty. But this is only part of the story. While globalization has brought more benefits for more people than ever before, it's also true that not everyone has benefited from the increased wealth. For many people, it can appear the bridge is bringing more problems than flowers, and that the economy isn't working for everyone or every country. So what should we do? Well, the solution isn't to destroy our bridges or to throw out the rule book. That would leave us all poorer and less secure. So, do we maintain, rebuild, or redesign these bridges? Write new rules that help them to work better? Or search for new ways to ensure everyone can benefit? Probably all of the above. More than ever, we need international cooperation, countries working together, and the IMF working with its member countries to build the best possible bridges to get us to the future. That will not just be good for the economy, but good for people everywhere.
Welcome back. Thank you for staying with us. Official figures show the world's second largest economy grew by 5.2% in the 3 months to the end of June compared to the same time last year. That's better than the 5.1% forecast by many economists, but lower than the previous quarter. The country has so far avoided a sharp downturn, partly due to measures announced by Beijing to help support the economy and a fragile trade truce with Washington. To get insights on this, we're joined by in-house economist Sanellis Biya. Sanellis, very good afternoon. Thank you for joining us on Market View today. Was this expected? The country has so far avoided a sharp downturn. What sectors could possibly contributed to the economic growth in China?
Thank you, Lungelele. So it's been quite interesting to see what's happening in terms of the numbers, both the imports and the exports data and overall growth data. So it actually has come to surpassed expectations in the sense that we expected the trade war to actually have vast negative effects on the growth of mainland China in the month under consideration. But one thing that we note, Lungelele, is when all of this happened, we saw a couple of things. Tariffs came in and then they were paused, and then that allowed markets to somehow steady up a bit. And then also one thing that we saw when you're looking at the numbers, we saw a bit of hoarding in terms of US buyers, just making sure that they're importing just as much as they could possibly, much as they could possibly can from China before the tariffs came into effect. But another factor that we saw come into play pretty much, Lungelele, was, we saw President Xi going very hard on that economic diplomacy drive, making sure that through the entire Asian region, the ASEAN countries is actually able to build them. Those relationships that are required to ensure that trade between the mainland China and the neighbors there continues to be strong. We also saw the same happen with Africa. China has been increasing and diversifying its footprint in anticipation of what was going to happen with the mainland, with the US. And then also another thing that we saw, Lungelele, is China has continuously been pumping some stimulus into the markets to ensure that the economy continues to stay afloat, even albeit these changes that we're seeing in the global trade order. So that when you look at trade with quite a number of the regions of the world, it did increase. It only just dipped when you compared it with the US. But overall, China is positioning itself as the most sustainable, the trustworthy partner that the people of the world could actually look forward to trading with right now, given the changes that are happening with the US.
All right. So now, Mrs. Bia, what does the second half of the year look like? What should investors brace for the rest of the year?
Second half of the year, Lungelele, is going to be a bit tough because right now, bit tough in quotes, Lungelele, not that it's going to be a bit tough, because we know a lot of the risk factors and a lot of the factors that can move or push markets and also push business sentiment forwards or backwards is, the wild cards that President Trump keeps throwing. And I say it might be a bit difficult if President Trump keeps true to his promise to Russia, where he said yesterday we saw him come out to state that if President Putin does not give us a peace deal within 50 days, he is going to impose tariffs and secondary sanctions on those countries that trade with the US. So right now, that is one of the things that we have to look out for, because when you talk of sanctioning countries that trade with Russia, that includes India, which is one of the fastest growing emerging economies. It includes China, and it includes quite a number of countries in Africa as well. So now that would push that Russia-Ukraine war from being a contained, localized war between Russia and Ukraine, and its effects would now begin to be global in the sense that once you start sanctioning China and India and the BRICS nations and those other nations, you are now making it a global problem. So we're waiting to see how that is going to play out. But in the event that we do get to that ceasefire deal, or we do get we get President Putin to get President Trump to call his bluff and not necessarily take much of the required action, then the second half of the year continues to look as the first half did, a lot of uncertainty, depending on what President Trump is going to say. Until and unless we get a clear deals coming out between the US and their major trading partners, then we are always at a threat of a trade war. So that's one of the major factors that we're going to be looking out for. And then again, recession fears have come back into the US economy. Again, we're going to be looking out for that and see how the economy overall is actually going to grow and push in that direction. But the risks remain the same, though we have dealt with some of the geopolitical risks. Those ones seems to be fading, so it does promise to be a good year, Lungelele. And also, given the fact that you can see, looking at the data coming out of China, it shows that countries are diversifying away from the US and trying to find other export destinations. So it does promise to be a not so bad of a year.
So generally speaking, Mrs. Bia, you would say that China's economy has remained firm for the first half of the year?
Yes. Remained firm for the first half of the year, and we're seeing it, showing signs of growth that we somehow thought were not going to come through from that Chinese economy. And I mean, the fact that they are still breaking that 5% target again shows some signs of resilience, because we'd expected that steam to die out. It should start dying out at a time soon.
Right, thank you, Mrs. B. And that's it from Insights from in-house economist Annelies B. It comes back for the final segment for today's market analysis. Stay with us.
Eswatini TV has signed a code of conduct that is enforced by the Eswatini Communications Commission. We are committed to reporting news that is accurate, comment that is fair, and programming that does not amount to hate speech or the description of gratuitous violence or explicit sex. For any complaints of our programming, please contact us on 2411-9600 or email info@eswatinitv.co.za. You can also contact the Eswatini Communications Commission on 2406-7000 or write a letter to ECCOM on PO Box 7811 Mbabane. Email address is info@ecom.org.za.
Welcome back. You're so tuned into Market View. This is our final segment. We take a look at today's markets with Annelies B. Sanil, welcome back. After a slow start of the week for markets yesterday, what's the reaction today? What's happening?
Thank you, Lungele. So what we're seeing with markets today is there's a bit of a rebound, coming through from the major markets there, and the U.S. markets again. We can see there's been a bit of a rebound coming through from that market again. That's purely because we're seeing a bit of movements that we somehow hadn't expected. We're seeing a bit of movement in terms of the tariffs. The fact that the tariffs have been held constant and they're not moving until probably year end, until probably August 1. And the fact that we're seeing President Trump taking a bit of a hardliner against President Putin of Russia. So now that has actually pushed up markets a bit. And the fact that, we're also looking at the US markets, and looking at the performance of companies like your NVIDIA, getting those much required licenses, and the fact that those chip stocks have not been interrupted by these tariffs. So now that we're seeing those coming into effect, and we're seeing that shoring up markets, and, for also focusing on performance, like markets today have shifted to just look at performance of those businesses while we push forward to the 1st of August. And then when you go into the European markets, one thing that we saw at the start of the day today said around 8:05 hours in UK, 8:05 hours GMT, we saw the FTSE 100 actually break that 9,000 mark, Lungelele. So right now we are waiting and watching to see if it is going to get above the 9,000 mark again, and then maintain the stance above the 9,000 mark. That's being driven by the fact that, we know there's a deal between the UK and the US, and then also, in terms of the fundamentals for growth, and we're seeing this new labor budget coming into effect. Even, it promises, with the way it's structured, is to get people off of welfare and get them back to work. So it's going to be a growth catalytical one there. And then also coming through to Europe, one thing that we're seeing, which supports these upward surges in the DAX gaining some 45 points, and the CAC gaining some 11 points there. So that's because we're seeing President Trump's tone towards Europe somehow being favorable, and also, being harder on Russia. When he made that notice yesterday that he was also going to continue supplying the much needed ammunition for Ukraine, and then also calling President Putin to come into play and come with a peace deal in 50 years. He did say that he's looking forward to Europe actually leading the way in terms of that, in terms of Europe paying for all these ammunitions, and one then gets to understand that President Trump is now looking at Europe in favorable eyes, and we should also assume that or expect that that favorable look will also trickle into the trade negotiations, and probably they are going to find each other pretty soon. So we should expect Europe to stay in the positives today and tomorrow, and then unless something else happens. Again, when you come into the Japanese markets, we're seeing a bit of a rebound again. The Nikkei, they're gaining some 218 points in today's trade, and the Hang Seng gaining some 386 points in today's trade. So it remains at those levels, and the Nikkei is struggling to get back to that 40,000 mark. That's because Japan is still trying to balance getting back on this positive interest rate territory, while at the same time balancing these the trade demands that are being made by the Trump presidency. But with mainland, we're seeing it maintaining above the 3,500 mark. But when we quoted the numbers, there was a bit of a decline there, but it's still above the 3,500 mark, showing that the markets in Asia really just performed very well in today's trade. And then South African Stock Exchange is at that 97,000 mark, but we know we can sense those jitteries regarding those tariffs, Lungelele, in the sense that the markets are failing to rally back to that 99,000 mark. So that means it's showing that South African markets are now becoming a bit cautious as the 1st of August approaches, and still there are no deals at play. Still there are no deals that have been put into place between the US and South Africa. And we've already seen Lesotho saying they've stopped shipping, because now as the deadline gets closer, Lungelele, you find that companies then don't send out shipments to the US, because you don't want to send a shipment today with this tariff level, and then when it gets there, the tariffs have changed. So we should expect a bit of a slowdown in that in trade in that direction. There hasn't been any movement in the Eswatini Stock Exchange. Gold is expected to continue on its upward surge as we get closer to the 1st of August, Lungelele. There we should expect gold to tick up a bit, maybe even get closer to the 3,400 mark as we get closer to August 1, and not unless then we get a bit of a clearer direction and a bit of communication coming out from there. And then when you look in the price of Brent crude oil, Lungelele, we are back at that $68 per barrel mark. And, we should expect these numbers to peak tomorrow when we see what happens with, the US CPI data there, because the fact that recession fears are coming back into the market, now that's going to push the price of oil even further down, because, if the US economy goes into a recession, we expect a bit more deceleration in terms of economic activity. In terms of the Lilangeni dollar exchange rate, we still stand on that close. We still stand firm on 17.79 emalangeni per dollar, which is a 0.64% change. And also we stand firm against the euro, and also we stand firm against the Japanese yen. Right now, what drives that, Lungelele, is the fact that Eswatini is somewhat a stable destination, in the sense that we have somewhat of a deal. We are not President Trump's target. So right now, those uncertainties with what is going to happen with the tariffs, we know that President Trump is targeting Europe directly, and we've seen that happening in the news, and then we also know that Japan is also a target. Again, that one is out there in the news, so we do expect those movements somehow work in our favor. Lungelele, thank you.
All right, thank you, Mrs. Bia, for that analysis today. It's 29 minutes after 2. We've come to the end of today's episode of Market View. Join us again tomorrow for Nedbank Business Watch at 2 p.m. Salagahle.